Welcome to the first episode of Financial Survival. My name is Sam Sutterfield, and today we're going to talk about some of the questions I get most often from my clients. A mutual fund is a way for you as an investor to buy into a basket of securities. Instead of investing in just one stock, you can buy into a mutual fund and you own shares of a fund where the fund has multiple different stocks. Mutual funds actually have multiple different types of investments in them. Mutual funds can have stocks, bonds, and even other types of mutual funds and exchange traded funds inside of them. Now. So when's a good time to start planning? It's early in your life. It's when you really first start your career. That's the time to start planning. A lot of people end up, going through half of their career and they wake up one day and find out that they haven't done anything with regard to planning. So the time to start is really as early as you can. It's never too late to start. Giving up is really not the answer. You still have time until you retire. You definitely have time to start planning. That's a tough question. When should you take your Social Security? It really depends on your financial situation. If you take it early at age 62, you're only going to get 75% of your benefit. If you wait till 67, you get 100%. If you wait till 70, you're going to get 132%. So it really depends on your financial plan, and your advisor should advise you on what year is the best year to take it. The best advice for a young investor would be to start early and really know what level of risk that you're taking. A lot of people will try to give you advice and steer you in the direction of taking the most risk possible. It's not always the best answer. So this is something we hear quite a bit. Your spouse isn't interested or they don't want anything to do with it. I would urge you to really bring them to the first meeting and let them meet us. Oftentimes what happens is you might pass away and your spouse had no idea how the finances worked or where the money is or what the money is doing for you. So it's really important for them to know who your financial advisor is and be involved as early as possible. In retirement, you have to worry about inflation. You have to really think about what costs are going to go up in retirement, and did you plan for that? Do you have rising income in retirement? Annuities get a bad name because of advisors that really don't know what they're doing and products that aren't available anymore. There were variable annuities, years ago that would charge you 3 to 4%, and they were sold in the wrong way. So annuities get a bad name because there are different types of annuities, and not everyone understands which ones are best for you. So fees are important when it comes to investing. You need to know what you're paying and what you're getting for the fee that you're paying. So the first or second meeting with your advisor, they should always be very forthcoming with what the fee is and what value you're getting for that fee. You get what you pay for. In some cases, the cheapest product or the cheapest service might be the best way to go. But in my opinion, when it comes to your finances, you don't always want to go with the rock bottom price. You want to go with someone that gives you sound advice and that's worth the advice that they give you. So when to change advisors, it comes down to communication and how your portfolio is being managed. If your advisor doesn't have enough time for you or they're not spending the time that you deserve, then it's time to take a look at a change. Without a pension, there's many different ways to guarantee an income. You have to talk to an advisor to find out the best way for you, but there certainly are ways where you can create a guaranteed income that will last you the rest of your life and the rest of the life of your spouse. So to guarantee your income in retirement, there's different ways to do that. One of the ways would be having an annuity. And I'll tell you, there's many different types of annuities. Think of it as if an annuity were a vehicle. There's different makes, different models, different bells and whistles that each one of them has. There's many different types, so you have to figure out which one's the best for you, and your advisor can help you with that. There are annuities that really can fill a gap. If you don't have a pension, there are annuities that can give you an income that's guaranteed the rest of your life. There are different investment vehicles. There's stocks, bonds, mutual funds, those alternative assets that are non-correlated to the market. So in your portfolio, it's important to have a mix of everything. So there really is no way to time the market. There's no way to know what's the best time to buy. No one has a crystal ball. The market's moving in cycles on a daily basis, so if an advisor tells you they know when to buy, they're lying to you. So there's never a great time to buy. You have to be ready emotionally to invest, and that's where your advisor can help you. So funding your kids' college or funding your retirement, you have to think about, how long you expect to live. And, nowadays, it's estimated that you'll live as many years in retirement as you did working. So it's important to fund your retirement first. Your kids' education can come later. If you have enough money while you're in retirement to help pay for that, there are student loans, there are other options. But really it comes down to what's important, and I think that your retirement's more important than funding anything else. So that's it for our very first episode. Thank you very much for watching. Don't forget to hit the subscribe button, and I look forward to seeing you again.